Welcome to ETF.com's Exchange Traded Fridays, a weekly podcast covering developments in the ETF industry. I'm Jeff Benjamin, Wealth Management Editor at ETF.com, and I'm your host for this episode. I'm talking with Johan Grahn, Head ETF Market Strategist at Allianz Investment Management. Hey, Johan, thank you for being here.
It's terrific to be here. Thanks for having me.
All right. Let's start by having you tell us a little bit about yourself and your job there at Allianz Investment Management.
Yeah, sure. So I spearheaded the team that built out and launched an ETF business for Allianz. We're based here in Minneapolis. And bottom line is that we've been managing the type of strategies that we have now and that we're now offering an ETF for a very long time on the insurance side. So a lot of your listeners might know us as Allianz Life, the insurance company. And, so what we do on that side is, manage structured products on the insurance side. And we took that and wrapped some of that expertise into ETFs, known as defined outcome ETFs or buffered ETFs, and launched that business in the summer of 2020. So that was the height of the pandemic when it was hard to find people that were willing to move around, and it was hard to hire people. And we kind of launched with a bit of a whisper because it was hard to get much of anything done aside from getting the ETFs launched. So it took us a while to raise the first $1 billion, but then over the past 18 months, we've tripled that. So we're now at about $3 billion and counting.
Yeah, good growth trajectory there. And Allianz Investment Management and the insurance side, it does seem like a natural segue into the buffered space. Tell us a little bit about the buffered space. I mean, it has grown pretty rapidly. What's causing that growth?
Yeah, it really has. I mean, it's grown by give or take, 10 billion a year over the last couple of years, and it's a $40 billion business today. Give or take 200. There's actually more than 250 ETFs in the space now, and roughly 50 different investment strategies that all fall inside of this defined outcome umbrella, if you will. And I think there are a lot of reasons for the growth. I mean, it's the first time that you can find a structured type of product inside of a liquid wrapper. So it's just opened up a completely new field for implementation. So you can think about all the portfolios that are big enough but still small enough to get into less liquid assets. They now have an opportunity to invest in a way where they know the outcome or the expected outcome beforehand. So you have a defined amount of downside protection. You have a defined amount of upside potential over a defined time period. So you can imagine like all the things you can do inside of a liquid portfolio now that you couldn't before. And as the education around this is growing and expanding, and lo and behold, there's the first book out now about buffered ETFs. It's percolating through, the financial press and everywhere, right? And the more awareness that's coming through, the more it's growing. So it's a little bit of it's a type of product that has opened up a whole new avenue of and ways of investing over the past 5 years. So I think we're still in the early innings here.
Let's back up a step and describe what we're actually talking about with buffered and defined outcome ETFs. Can you give us a summary? I mean, for our audience, they're obviously they're called buffered because they have something on the upside and something on the downside. But go ahead and explain it, Johan.
Yeah, totally. Thank you for that. So effectively, like in a simple way, you can think about a buffered ETF, which is the core, the core type of strategy in the defined outcome space. So a buffered ETF gives you exposure to an index, let's say the S&P 500, and you have a buffer underneath of that exposure, so that if the market goes down, if the buffer is, call it 20%, the market can be down by 20% or less, and you're still made whole. So if you put $1 million in on day one, the market is down 20% the way it was in 2022, you still have $1 million gross of fees at the end of that outcome period. And then, of course, that 20% layer of protection, that buffer isn't free. So the way we structure the ETF is that we're trading options in such a way that we're selling away some of that upside in order to pay for the downside protection. And what it means for you as an investor, if you take the year of 2022, you could only make, for example, 15% on the upside.
Mm-hmm.
So there is a max in terms of how much you can make, but there is also a defined immediate buffer that protects you against losses. And then the third variable in these funds is the time period. So this layer of buffer and that cap is in place over 12 months, for example, or it could be over 6 months. It depends on which product you're going for. But so that's in essence how it works. So very simply put, you have a layer of protection in the buffer, and then there is a certain amount of money you can make on the upside, tracking the S&P 500 and using that as an example.
And to be clear, you can buy, these are usually issued on the first trading day of a month and run for 12 or 6 month periods, but you can buy them at any point after the issue date. But in order to get the I guess the guarantees or the buffer, you have to hold them to maturity, correct?
Right. Yeah. So to be nitpicky only for compliance reasons, it's not a guarantee as an insurance product. It's still an investment management product. But yes, you're right. Like if you buy that typically investors will buy them on day one or the day before they reset. So you have that 365 days over which that structure is in place, and then at the end of that outcome period, and this is important too, we reset that cap and buffer. We do that trading inside of the ETF so that you don't have to as an investor. So if the market's trading up, and let's say that this ETF has gained 10%, let's say over that 1 year, your $1 million is now worth $1.1 million. That new buffer will be placed under the $1.1 million. So now you have the buffer is kind of moving up as your assets are growing. And then since it's done inside of the ETF, it's not a taxable event. You can just own the ETF in perpetuity. You don't have to own it for just a year. You can own it for 10 or 5 or however long you want.
Okay. You've already laid out how this is a competitive space. It's a fast growing space. How does Allianz differentiate itself?
Yeah, so we're built around risk management. It's what we've done for decades. So everything we do is done in-house, first of all, right? So the portfolio managers and the traders, the operations, it's all set up to manage risk. And it can sound kind of boring, but it's a really, really important function because all you're doing is making sure that you're trying to hit a target day in and day out. And the way we do it is by trading options, to manage risk and hedge risk across the Allianz affiliates around the world. So with that, we have an operation of running through, give or take, $10 billion in notional trading every day, and it's in the trillions every year. So we're taking the expertise that we have, like what we do and have done for decades and decades at end, is now something that we are providing in an ETF. So I think we're also less expensive compared to the biggest players out there. And there are some nuances, right? But the key differentiator is that the expertise is very important. And with that, we can also offer up a very specialized ETF sales team so that since this is all we do, they're very highly trained on this. And that's another differentiator. They can help educate and provide services to advisors that are looking at this.
You said this is all we do. You mean buffered products?
On the ETF side, it's all we do, yes.
Okay.
Defined outcome ETFs, buffered ETFs. That's correct, yeah.
Lay out your lineup for us then, your ETF lineup.
Yeah, so first of all of our ETFs are currently on the S&P 500. So it's S&P 500 exposure, and it comes either with a 10% buffer or a 20% buffer where the upside is capped over a 12-month outcome period. We also have a 10% buffer that is capped on the upside over a 6-month outcome period. We also have a 6-month outcome period ETF that has a 5% floor. That's also capped on the upside. So there is a max amount of money you can make on the upside, but you can never lose more than 5. And then the latest innovation that we launched a few months ago, started launching a series of buffer ETFs with a 15% buffer, where the upside is uncapped, unlimited, however you want to phrase that, after you've met a certain performance threshold. So if the S&P 500 over a 12-month outcome period is above that threshold, and it's about 3.5%, then you get to keep all the returns beyond that threshold. And the beauty of this product is that most investors look like you have, let's say that you have 10 years left in this portfolio, or 15 or 20 you're expecting to live for a while, and you can afford to have equity exposure, but you can't really afford to have 100% equity exposure. A product like this will give you that opportunity to participate in those years that matter the most, which is those years that the S&P 500 is performing really well. So it's the flip side of the capped buffers. This is the uncapped version. So it's a slightly different implementation, but it gives you a greater upside over time than a capped buffer would do.
Okay. And to be clear, when you say buffer, just for our audience, you're referring to the downside, the downside
That's correct.
protection.
Yeah.
Right.
So if the market, so in the case of the 15% buffer, and think about it this way: if you picture a bar chart, and you go back like however many years you want, and each calendar year has a bar showing how much the S&P 500 was up or down. If you draw a line underneath of that at negative 15%, you will not take any of those 15% down years, so to speak, or anything that's 15 or less you won't get. You will only get, if the market is down 20%, for example, you're going to lose 5. If it's down 16, you're going to lose 1. Anything beyond 15 you will take, but nothing.
Now you referenced the caps, the upside performance caps, but what are they?
So good question, right? So they will change over time, and they're all determined by the market environment and the pricing of the options. So just to make clear, it's not a cap that we arbitrarily decide what it's going to be. There's no extra money laying around. We always aim to maximize it based on what the market can give us. And that's primarily driven by interest rates and volatility. So higher volatility tends to lead to higher caps, for example. Now, in a 10% buffer, right now you can see caps, call it 18%. And in a 20% buffer, the caps are now maybe give or take 11%, something to that effect. Again, they move around, right?
Okay,
time.
But to be clear, you say they move around, but they move around as they're reissued. They don't move around during
Thank you for that. Yeah, that's a good point. Yeah, once you have it set, it stays there for the remainder of the outcome period, and then when we reset, 365 days later, if the cap was 16%, on day one, and then we reset 365 days later, maybe the cap is 18 if the volatility has come up, or maybe it's 15. It depends on the market at that time. Yes, but it doesn't move throughout the outcome period. You're correct.
If you're a financial advisor and you want to hear the latest insights and strategies in portfolio management, make sure to also subscribe to Advisor Upside, available wherever you get your podcast. Now, there's a new twist on these things coming out, or they're already out there. They've been out for a year and a half or so, with 100% downside protection, meaning what you invest on day one, at the end of that period, no matter what the market does on the downside, you're getting your principal back. Is Allianz considering anything like that?
So I can't really talk about what's in the product lab, but it's a decent sized lab, and we have a long list of ideas that we are at different development stages with. So that much I can say, and I can also tell you that it will be within this defined outcome ETF space. We'll stay true to the risk management DNA that we have.
All right, I like that. A product lab. I bet you that'd be a fun place to visit sometime. Maybe we could set that up when I'm in Minneapolis. All right, these are, as we've already gone through, they're relatively complex products. They're not just buying the S&P 500 and getting whatever you get through an ETF like SPY or something like that. How do you explain them to financial advisors and ultimately investors?
Right. So, I mean, it comes down to, I would probably put this in three buckets. It's education first, how do these work? And then number two, individual use cases, like how could we use them in a portfolio?
Hmm.
And then the third is like the portfolio implementation, how you think about that. So it's almost like a staged approach. But once you understand the buffer and the cap and the time period, it's really just three variables. How much downside protection do I get? How much upside do I have? And over what time period can I expect it? So it's a relatively easy hurdle to get over when you're talking through that. And it's especially easily absorbed, for advisors that are already familiar with insurance products, for example, or structured notes or hedged equity.
Uh-huh.
It's not a difficult conversation. And then the question is, okay, well, do I want to use it to, de-risk equities, or do I want to use it to up risk or replace fixed income, or do I want to think about this as a great diversifier in my alternatives bucket? Or fourth use case tends to be, do I want to use this to move some cash off the sideline and get it invested, with a nice chunk of protection underneath of it. So
Hmm.
that would be on the use case side, right? And then you can go into conversations about portfolio implementation, talk about, what kind of sizing do I need, how do I think about upside correlation and downside correlation? You can get into those semantics, Sortino ratios, however complicated you want to make it. But since these products are structured, they come with a really, really interesting asset allocation, portfolio implementation, and construction conversation once you get into it. But that would be like the third layer in, if you will, in terms of
Uh-huh.
where you take that education.
What's the market here? To me, and you and I have talked a good bit about this over several conversations,
Hmm.
and I've written a good amount on these things. I don't see a market for somebody who is not in or near retirement. But you tell me. I mean, they've been referred to as boomer candy, for example, baby boomer.
Yeah.
What who do you think these buffer strategies or defined outcome strategies are kind of designed for?
Well, that is the sweet spot. If you're young and you're saving and you have, you know, uh, at least when you're young, you have seemingly endless amounts of time
Hmm.
to live, right? Then you don't need these products. I mean, I think that's a straightforward answer. And the target market is, when you start thinking about not just owning 100% equities, whether you are retired or thinking about retiring, or if you're just more conservative, or you turn more conservative if you get an inheritance, for example, you're not sure what to do with the money, but you don't want to, risk it all. Anyone that says, here's the short answer for you: anyone who is not interested in only owning equities,
Hmm.
because any one of those investors will have to make a decision and say, well, I don't like being long only equities. What options do I have? So for any one of those investors, this is something to look at and to evaluate if it's something that they're interested in. Because the option otherwise would be to say, I don't like equities, I'm going to have to move to bonds. Well, what if I don't like bonds?
Hmm.
Or what if I move to bonds and I'm more or less guaranteeing myself a lower rate of return over time, because bonds have a lower risk premium attached to them relative to equities? Why don't I consider putting a buffer underneath of my equity position, allowing me to capture that equity risk premium over time? Which is especially true in the case of the uncapped 15% buffer that we have. That's a perfect play for somebody who is thinking about starting to think down those lines, because they have time on their hands to invest.
What
So yeah, go ahead.
what market environment are these best suited for, or does that even matter because of the buffer characteristics?
Well, It's a I don't mean I don't I don't want to be too flip with my answer, but if you are trying to invest based on different market conditions, you're talking about tactical trading more so than anything, or opportunistic trading. And if you're a tactical trader, then it depends on how confident you are and what kind of bets you're placing and all of this, right? And there's actually some really interesting use cases for buffered ETFs for tactical trading as well. Think about it this way: if you want to overweight equities in a traditional way, you take that money from fixed income, for example, and you move it into equities. The second you do that, and you keep the same benchmark, keep in mind, the second you do that, if the market goes against you, you're creating negative alpha, as opposed, and if the market goes up, of course, you're generating positive alpha. I'm simplifying this a little bit, but if you instead overweight into a buffered ETF and the market comes down, well, you didn't create necessarily negative alpha right away because you're in that buffer zone. But if the market goes up, you're still creating alpha. So, but that's on the tactical side, and I don't think that isn't necessarily what you're asking about. But the answer is, and you alluded to it, it doesn't really matter because you're buying these ETFs for the same reason that you buy a different asset if it's a strategic holding. You're just buying it in place of something different. So the obvious answer would be equity markets are up, give or take 7 times out of 10 annual periods. Chances are you're going to be up. The chances of making money in a buffered ETF are greater than they are losing money. So over time you should be increasing the opportunity of generating more assets as opposed to being in a lower yielding asset class, so to speak.
What's the impact of interest rates on these strategies? How does that impact the cap and the buffer?
So it's the interest rates will help the caps so higher interest rates are associated with higher caps, to keep it simple. But in the terms of the capped products, volatility plays a bigger role. And the neat thing here is that when you have volatile markets, that's of course when more investors, too late, albeit, but when they start thinking about risk management, and that's also when the caps tend to go to look a little bit more attractive, right? Because they go up. It's driven by volatility more so than rates.
All right. Now, we haven't talked about the fees yet. You already detailed that these are typically benchmarked to indexes, which are, as we know, pretty much dirt cheap out there these days. But as you also detailed, these shouldn't be compared specifically to the benchmark, the underlying benchmark. But still, these are not what are they're around 60 basis points, something like that.
74 in our case. Yeah.
So, is that a case, an argument you can make?
Absolutely, yeah, and you're kind of hitting the nail on the head because and I think I mentioned it before, right? If you want to own equities and just have an equity exposure in a portfolio, yeah, don't buy don't buy our ETFs, right? They would be very expensive, and I fully recognize that. You should never buy our products, because you want to have pure equity exposure. You buy them because you have a list of other things that you can consider buying, and whatever those things are, that's what you can compare against. So I'll go back to the bond example because it's simple, but we can use alternatives, we can use real estate, high yield, you name it. If you buy, let's say, a fixed income fund that happens to be charging, I'll make this up, 35, half, give or take, 35 basis points. It's still a whole lot more than what you would pay for an S&P 500, right? But you're happy buying that because you're getting the income piece, you're getting the stability, you have less volatility, you have a purpose behind that investment. And it's going to cost you, again, 35 basis points, let's say. Well, when you do that, you're also saying, I'm okay with the lower expected return. And, right? So a little bit higher expense, lower expected return. The same is true if you, instead of doing that, you buy a buffered ETF and you say, I'm fine with a lower expected return than owning just equities because I'm getting that risk mitigation on the downside, which is what I really want, which is why I'm moving assets from equities in the first place. Now, by going into this buffered ETF that for all intents and purposes might be twice as expensive as the bond fund, why would I do that? Well, you do it because you have a higher expected return over time from the buffered ETF than you do from the bond fund. So, and that can be incredibly meaningful, especially if you're investing over the next, like 5, 10, 15, 20 years. That compounding effect and that upside potential is well worth, in my opinion, the extra cost of having somebody structure and manage an options package for you, running it through the institutional piping, making sure that it's managed in a tax efficient way, that the cap is maximized. And by the way, if you have 100 or 1,000 clients, you can satisfy all of them just like you would buying any other ETF, but you're getting a structured product into your portfolio with a one-click buy in a block trade through your trading desk. So you tell me if you think it's worth it or not, but I happen to do that. It's a pretty quote unquote low price to pay for all of the benefits that it comes with.
Okay. I know that you're not going to let us into the Allianz Investment Management Lab yet, but can you give us a sense as to whether or not Allianz would be moving beyond buffered products at some point in the ETF space?
Well, there are different ways to structure defined outcomes. There are different ways there's actually a lot of things you can do with options, in terms of what you're structuring. There's obviously different indices to look at. There are different combinations of funds that you can build. We've already filed. So this is public. We filed for, fund-of-fund ETFs, for our 10% and our 20% buffer. So if you don't want to buy our ETFs piecemeal, you'll be able to buy just one ticker, and we'll manage the underlying ETFs on your behalf inside of it. But to answer your question in a more vague way, perhaps, like I think I alluded to before, we'll stay true to the defined outcome space for the time being here.
Okay. On that note, we're going to let you go, Johan. Thank you very much for being here. Great talking to you. Always interesting and insightful. Johan Grahn, Head ETF Market Strategist at Allianz Investment Management. Thank you, sir.
Yeah, terrific, Jeff. Always nice to chat to you.
Thanks for listening, folks, and make sure to check out ETF.com for all the news and information about the ETF industry. I want to remind everyone that Exchange Traded Fridays will be taking a hiatus for the month of August, with our next episode scheduled for September 6th. See you then.